You've been trained to fear rising interest rates. For over a decade, every time the news even whispered about rates going up, the conversation immediately turned to economic doom, market crashes, and the crushing weight of debt. You saw the headlines. You felt the anxiety. You were taught that low interest rates were the fuel for a happy economy, and high rates were the emergency brake nobody should ever pull. This story has been drilled into us so deeply that the phrase high interest rates probably makes you flinch. You think of your mortgage getting more expensive, your credit card balance becoming more suffocating, and your dream of buying a house slipping further away. And look, those fears are real. We're going to talk about them. But you've only been told half the story. What if I told you that you've been looking at it all wrong? What if those same high interest rates, the ones the media paints as a monster in the closet, are quietly creating the biggest wealth-building opportunity for regular people that we've seen in over 15 years? What if these rates aren't the villain, but the unsung hero for anyone trying to build a stable financial future? Today, we're pulling back the curtain. We're going to dismantle the fear-based narrative you've been sold and show you how to turn this widespread anxiety into your single greatest financial advantage. It's time to unlearn what you've been taught and see high interest rates for what they really are, your new best friend. To get why high rates are your friend now, we first have to understand why you were conditioned to believe they were your enemy. It all goes back to the world we lived in for more than a decade after the great financial crisis of 2008. Imagine the economy is a car that just stalled on the highway. It's sputtering, slowing down, and there's a real danger it could just stop completely. In that scenario, central banks, like the Federal Reserve in the US, have a toolkit to get the car moving again. Their go-to tool? The interest rate. By slashing rates to near zero, they made money incredibly cheap to borrow. This was like pumping the cheapest gasoline imaginable into the economy. The goal was to get everyone, from huge corporations to you and me, to borrow and spend money. Take out that business loan, buy that new car, refinance your home. The message was loud and clear. Spending is good, borrowing is easy, and saving is, well, kind of pointless. This cheap money era lasted a very long time. A whole generation of people grew up knowing nothing else. We got addicted to it. Our entire economic system became dependent on this constant IV drip of low-cost debt. Companies that weren't even profitable could stay afloat for years just by taking out new, cheap loans to pay off their old ones. The stock market soared, not always because businesses were crushing it, but because when money is free, it encourages a lot of wild bets. So naturally, when the central banks announced they had to take away the cheap gas and raise rates to fight new problems like runaway inflation, the immediate reaction was panic. We were told the car was going to stall out again. The party was over. Everyone braced for impact. The media cranked up the fear because fear gets clicks. And so the narrative was set. High rates are bad. They're a punishment. They're a warning sign of recession. But this story completely ignores the silent victim of that decade-long cheap money party. For every borrower who loved those rock-bottom rates, there was a saver who was getting punished, plain and simple. And for the better part of a decade, that saver was probably you. Think about the most basic responsible financial advice anyone ever gets. Save your money. We're told to build an emergency fund, to put money aside for a down payment, for our kids, for retirement. We do the right thing and put our cash into a savings account, thinking we're being smart. But what happened during that decade of zero interest? You did the right thing, and you were punished for it. The average interest rate on a savings account was often as low as 0.01%. Let's be perfectly clear about what that means. If you had $10,000 saved, a huge accomplishment, you earned a grand total of $1 in interest over an entire year. Meanwhile, your bank was lending out your $10,000 for mortgages and car loans at 3, 4, or 5%, making hundreds of dollars, while tossing you a single dollar for your trouble. It was a joke. But it gets worse. During this time, inflation was still a thing. Inflation is the silent thief that makes your money worth less over time. Even at a so-called low inflation rate of 2%, if your savings are only earning 0.01%, you are actively losing 1.99% of your spending power every single year. You are saving. You are slowly going broke. You are doing the responsible thing, and your wealth was just eroding day by day. This was especially brutal for retirees and anyone on a fixed income. These are people who played by the rules their whole lives, saved up, and now depend on the income from their savings to live. Low interest rates crushed them. They had a terrible choice. Either watch their savings produce zero income and lose value to inflation, or be forced to take on way more risk by throwing their life savings in volatile stock market. There were no safe, stable options with a decent return. The game was rigged against the responsible. So when people tell you to fear high interest rates, just remember who the low rates were good for: borrowers, speculators, and zombie companies. And remember who got punished: savers, retirees, and anyone who was financially prudent. The era of high interest rates isn't the end of the party. It's the end of the punishment. It is the beginning of your reward. This is where your thinking needs to flip. This is where you stop seeing high interest rates as a threat and start seeing them as an incredible opportunity. The same force that's making headlines for jacking up mortgage costs is also working behind the scenes to put more money directly into your pocket. Let's break down the 3 immediate, powerful ways high rates are your best friend. Benefit number 1, your savings finally work for you. The days of earning $1 on $10,000 are over. Welcome to the world of high-yield savings accounts, or HYSAs. Because the central bank has raised rates, banks are now actually competing for your cash, and they're willing to pay you for it. As of late 2025, we're seeing HYSAs offering rates of 4.5%, with some even pushing 5.0% APY. Let's run the numbers on that same $10,000. Instead of earning $1 a year at a 5% rate, you're now earning $500 a year. On a $20,000 emergency fund, that's an extra $1,000 a year. This isn't a trick. It's not some risky investment. It's just interest. It's your money sitting at a safe FDIC-insured account, finally pulling its own weight. This is pure passive income, and it's not just HYSAs. You have options now. Certificates of deposit, or CDs, let you lock in a high rate for a set time, often for an even better yield. Money market accounts are another fantastic choice, offering great rates while often giving you a debit card and checks. For a decade, your cash was a dead asset. High interest rates have brought it back to life. Your cash is now a dynamic, income-producing part of your financial plan. This is the single biggest and easiest benefit, and it's available to everyone right now. Moving your money from a traditional savings account, which still often pays a shockingly low rate, to a high-yield account is the easiest financial win you will get all year. Benefit number 2, the glorious return of boring investments. The second benefit is just as powerful, especially if you're planning for the long term. High interest rates have brought back a whole category of stable, predictable investments that basically went extinct. Bonds. For years, the gurus all said you had to be in stocks. Kina, they called it. There is no alternative. Government and corporate bonds paid so little that they couldn't even beat inflation, so it made no sense to own them. This forced everyone, even people close to retirement, to be way too exposed to the wild swings of the stock market. That world is gone. Today, you can buy U.S. Treasury bonds backed by the full faith and credit of the government, considered one of the safest investments on earth, and get a respectable yield. High-quality corporate bonds from stable, profitable companies are paying even more. What does this mean for you? It means you have choices again. You are no longer forced to take on 100% stock market risk to grow your money. You can now build a balanced portfolio. You can put a portion of your investments into bonds that provide a steady, predictable stream of income, acting as a shock absorber when the stock market inevitably gets choppy. This is all about rebalancing your portfolio. It lets you lower your overall risk without killing your ability to earn a return. High interest rates have given you back the power of diversification. The boring investment is back, and it's one of the best tools you have for building resilient, long-term wealth. Benefit number 3, you can finally beat your real enemy, inflation. The third, and maybe most important, benefit is that high interest rates are the world's best weapon against inflation. Remember that silent thief eating your savings? Central banks raise interest rates for the specific purpose of fighting that thief. By making it more expensive to borrow, they cool down spending, which helps bring prices back under control. But for you, it's even more direct. When you can get a 5% return on your savings and inflation is, say, around 3%, you are no longer losing buying power. You are gaining it. Your wealth is growing in real terms. You're getting richer, not just on paper, but in what your money can actually buy. This is the whole point of saving and investing, to grow your purchasing power. For over a decade, that was almost impossible to do without taking big risks in the stock market. High interest rates have changed the game. They let you achieve real wealth growth from the safest part of your portfolio, your cash and bonds. They turn your savings from a victim of inflation into a victor over it. Look, we're halfway through, and we've already seen how high rates can pad your savings, stabilize your investments, and protect your money from inflation. If you're starting to feel this shift in thinking and you want more straightforward financial strategies that go against the grain, do me a huge favor and hit that subscribe button and the little bell. My goal here is to give you the tools to see the financial world for what it really is and to turn every situation into your advantage. Now, let's zoom out from your personal savings and talk about what high rates are doing to the market as a whole and why this creates a much better environment for smart investors. For the past decade, the stock market often felt more like a casino, with money being so cheap, it fueled a ton of reckless behavior. This brings us to another huge benefit of this new high-rate world. Benefit number 4, the purging of dumb money and zombie companies. When debt is basically free, you don't have to be a good business to survive. You just have to be able to borrow. This led to the rise of what economists call zombie companies. These are firms that don't actually make enough profit to cover their own debt payments. They stay alive by constantly taking out new, cheap loans to pay off the old ones. These zombie companies are a drain on the whole economy. They suck up money, talent, and resources that should be going to innovative, profitable companies. They create a fake sense of economic health while hiding a lot of weakness under the surface. High interest rates are the cure. When the cost of borrowing goes up, these zombie companies can't afford to play the game anymore. The dumb money that was propping them up dries up, and they're forced to either get their act together and become profitable or go out of business. While that might sound harsh, it's an incredibly healthy process. It's like a forest fire that clears out all the dead wood, allowing healthy new trees to finally get some sunlight and grow. Capital gets reallocated from failing businesses to strong ones. This leads to a more efficient, productive, and resilient economy for everyone. So you as an investor, this is fantastic news. It means the market is becoming more rational again. It's shifting away from rewarding wild speculation and back towards rewarding the fundamentals, profitability, a strong balance sheet, and real growth. This is exactly the kind of environment where legendary investors like Warren Buffett thrive. Benefit number 5, the Warren Buffett playbook becomes king again. Warren Buffett has long said that interest rates act like gravity on asset prices. When rates are low, gravity is weak, and everything can float to valuation levels that just don't make sense. But when rates are high, gravity reasserts itself, pulling everything back down to earth. Buffett's philosophy is timeless. Buy wonderful companies at a fair price. In a high-rate world, this philosophy shines. Investors are no longer just chasing hype and promises. They're looking for quality. They want companies with a real competitive advantage, low debt, and the ability to generate cash right now. And as Buffett has pointed out, the risk-free rate you can get from government bonds is the yardstick against which every other investment should be measured. If you can get a guaranteed 5% from a treasury bond, a stock or a piece of real estate has to offer a potential return that is much higher to justify taking on the extra risk. This raises the bar for what counts as a good investment. This creates incredible opportunities for patient, long-term investors. While some of the high-flying speculative stocks might struggle, solid, value-oriented companies become way more attractive. Historically, some of the best times to buy stocks have been when interest rates were high because valuations were more reasonable, and the eventual drop in rates provided a powerful tailwind for the market. The benefits don't just stop with your bank account or your brokerage statement. High interest rates, despite their painful side effects, are working to create a more stable and sustainable economy for all of us. One of the biggest pain points is the housing market. And it's true, higher mortgage rates have made homes less affordable. But it's crucial to see the other side of that coin. For years, low rates fueled a speculative frenzy in housing, pushing prices to insane levels that were totally disconnected from local incomes. This created massive affordability crises in cities all over the world. Higher rates, while painful, are the necessary medicine to cool that down. They curb demand, which can lead to a stabilization or even a correction in home prices, giving the market a chance to get back to some version of sane. More broadly, high rates encourage a cultural shift away from excessive consumption fueled by debt, and back towards a culture of saving and disciplined investment. This is just fundamentally healthier. An economy built on a mountain of debt is fragile. An economy built on a foundation of savings and productive investment is resilient. Of course, there are trade-offs. Higher borrowing costs can slow things down and cause real pain for people with a lot of debt. Nobody is denying that. But to frame this as purely negative is to miss the big picture. It's like a doctor prescribing bitter medicine to cure a serious illness. The treatment might be unpleasant, but it's essential for long-term health. High interest rates are the economy's bitter but necessary medicine. Knowledge is only power when you use it. So let's go from theory to practice. Here are 4 simple things you can do this week to start making high interest rates work for you. Step 1. Audit your cash. This is the first and easiest step. Log into your bank account. Look at your savings. What's the interest rate? If it starts with 0.0, you are losing money. Go online right now and search for best high-yield savings accounts. You'll find tons of FDIC-insured online banks with great rates. Opening an account takes about 10 minutes. Moving your emergency fund and any other cash you have sitting around into one of these accounts is a non-negotiable. You're leaving free money on the table otherwise. Step 2. Reevaluate your investment plan. Look at your investment portfolio. Are you still running on that old Tina mindset with almost everything in stocks? Now is the perfect time to think about rebalancing. I'm not saying sell everything, but think about adding some stability. Look into bond ETFs, exchange-traded funds, for easy exposure to government or corporate bonds. Consider building a CD ladder, where you buy CDs with different maturity dates to get a good yield while keeping access to your cash. This is your chance to de-risk your future. Step 3. Become an aggressive debt repayer. Here's the flip side. Just as high rates reward saving, they viciously punish borrowing. High interest debt, especially on credit cards, is more dangerous than ever. That 20% APR is a wealth-destroying monster. Make a plan to attack and eliminate this debt now. Use the extra interest you're now earning from your savings to make extra payments on your debt. Every dollar you pay down on a high-interest loan is a guaranteed, tax-free return equal to that interest rate. Step 4. Master your mindset. This is the most important step of all. You have to fundamentally shift your perspective. Stop seeing interest rates only as a cost. Start seeing them as an opportunity. Celebrate the interest that hits your savings account each month. See bonds not as a boring relic, but as a powerful tool for stability. Understand that a market that punishes bad companies is a market that will, in the long run, reward good investors. For more than a decade, the financial system was tilted in favor of the borrower, the speculator, and the reckless. The prudent saver was left behind, punished for being disciplined. That era is over. The return of high interest rates represents a great rebalancing. It's a return to a world where financial discipline is rewarded. A world where your savings account actually helps you save. A world where you have safe, stable options to grow your wealth. And a world where the economy in the long run gets healthier and more rational. You've been conditioned to fear this new world, but now you have the knowledge to thrive in it. You understand that high interest rates aren't your enemy. They're a powerful tool, and now that tool is in your hands. You're no longer just a spectator in your own financial life. You're in control. You have what you need to turn what everyone else sees as a crisis into your personal wealth-building machine. So let me ask you, what is the one thing you're going to do this week to make high interest rates your best friend? Are you finally opening that high-yield savings account? Researching a bond ETF for your portfolio? Making an extra payment on that credit card? Share your first step in the comments below. Let's start building together.